Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Baidu Inc. annual report. Baidu Inc. provides a wide range of services through its internet platform in China. At its core, the company offers online marketing services, including search-based and feed-based advertising, as well as cloud services and other products based on artificial intelligence, AI. The Baidu Core segment also operates several popular apps, such as Baidu App, Heyakan, and ERNIE Bot, which provide users with access to various services, including search, content, and social media. In addition to its online marketing services, Baidu offers a range of non-marketing value-added services. These include knowledge and information products, such as Baidu Wiki, Baidu Knows, and Baidu Experience, which allow users to share and access knowledge and experience. The company also provides AI-powered solutions for various industries, including auto and smart home. Baidu's IQIYI segment operates an online entertainment video platform that offers a wide range of content, including original, professionally produced, and user-generated videos. Other notable services provided by Baidu include its mapping service, Baidu Maps, which provides users with travel-related information, AI chips, and Apollo Go, an autonomous ride-hailing service. Overall, Baidu's diverse portfolio of services reflects the company's commitment to innovation and its goal of becoming a leading technology company in China. Baidu Inc. market capitalization of $342 billion is significantly larger than the average industry peer of roughly $19 billion. This shows that Baidu Inc. holds a significant advantage in their industry. Baidu Inc. trades at a higher price-to-earnings ratio of 73 times and a lower price-to-book ratio of 0.14 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company maintains a moderate leverage profile, with liabilities making up 34% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The income statement shows that the company revenue have been declining annually even though operating income have been improving. Although the drop in revenue is concerning, we can tell that management have been able to reduce cost. The primary drivers of revenue growth or decline for Baidu and IQIYI are multifaceted and influenced by various factors. Regulatory changes in China can significantly impact their business, while industry trends and new technologies can either boost or hinder their revenue. Competition from existing and new entrants in the market is another crucial factor that affects their revenue. The company's ability to anticipate user preferences and provide high-quality content is essential for revenue growth. Online marketing services, cloud services, and video membership services are significant revenue drivers for Baidu and IQIYI. However, challenges such as indemnification obligations, litigation, and unrealized gains/losses on available-for-sale investments can also impact their revenue. In conclusion, the primary drivers of revenue growth or decline for Baidu and IQIYI are closely tied to their ability to adapt to changing market conditions, provide innovative services, and maintain a strong brand presence. By understanding these factors, investors and stakeholders can better assess the company's potential for growth and success in the future. The net income of the company experienced a significant increase in 2023, rising by 186% compared to the previous year. This surge was largely attributed to improved profit margins, which increased by 166%. However, this upward trend was short-lived, as the net income declined by 1.7% in 2025. The decline in net income and profit margins can be attributed to various factors. The challenging macroeconomic environment had a negative impact on online marketing demand, leading to decreased advertising budgets and spending. Additionally, the company struggled to retain existing customers or attract new ones, further exacerbating the decline. Uncertainties surrounding the commercialization of foundation models and generative AI also contributed to the downturn. The shift away from traditional search plus newsfeed models and increased competition led to downward pressure on prices, resulting in decreased profit margins. Higher customer acquisition costs and decreased use of search and paid clicks due to voice-activated smart devices and social media platforms further eroded profitability. By 2025, the company's profit margins had plummeted to -4.5%, indicating a significant decline from the previous year's 18.2%. Based on the extracted summaries, it appears that the company has experienced fluctuations in its ability to generate positive operating cash flow over the years. In 2021 and 2023, the company was able to produce a positive operating cash flow, indicating a strong financial performance during these periods. However, in 2022, the company's operating cash flow turned negative, suggesting that it faced some challenges in managing its finances effectively. Furthermore, this trend continued into 2025, where the company again failed to generate a positive operating cash flow. Fortunately, by 2024, the company had regained its footing and was able to produce a positive operating cash flow, indicating a return to financial stability. Overall, while there have been some ups and downs, the company has demonstrated an ability to bounce back and maintain a positive operating cash flow in certain years. The company's debt level has experienced significant changes over the past 2 years. Between 2024 and 2025, the total debt increased by 10.6%, rising from RMB 144.2 billion to RMB 159.4 billion. Furthermore, long-term loans saw a substantial increase of 227.5% during this period, jumping from RMB 15.6 billion to RMB 51 billion. In contrast, the company's interest expenses have shown a decline over the past 2 years. Between 2023 and 2024, interest expenses decreased by 424 million RMB. Although there was a slight decrease of 40 million RMB from 2024 to 2025, it is worth noting that there is no explicit mention of a significant change in interest expenses for the year 2025 compared to previous years. The performance of various segments and regions within Baidu's operations has been mixed, with some areas excelling while others struggled. Regions that performed well include Beijing, Chongqing, Wuhan, Shenzhen, Pingshan, Shanghai's Pudong area, Dubai, Abu Dhabi, the UK, Switzerland, and South Korea. These cities have granted permits for fully driverless ride-hailing services or are in advanced stages of testing autonomous vehicles. Baidu General Business also saw a 1% increase in revenue from RMB 100 and 3.5 billion in 2023 to RMB 100 and 4.7 billion in 2024. On the other hand, segments that performed poorly include Xiaodu Smart Products, Smart Living Group, SLG, and Financial Services Business, Du Xiaoman. These areas did not meet expectations, with no specific details provided on their performance. Additionally, IQIYI saw an 8% decrease in revenue from RMB 31.9 billion in 2023 to RMB 29.2 billion in 2024, followed by a 7% decrease in revenue from RMB 27.3 billion in 2024 to RMB 25.9 billion in 2025. The management is signaling a cautious approach to the company's outlook and strategy. While revenue growth is expected, net income is projected to decrease significantly in 2025 due to various factors. The company is also grappling with uncertainty regarding its passive foreign investment company, PFIC, status, which may impact its operations. To mitigate risks, management has implemented measures such as hedging transactions and interest rate swap contracts to manage foreign currency exchange risk. Additionally, the company is focusing on improving tax disclosures through the adoption of new accounting guidance. Regulatory considerations are also a key area of focus, with the company evaluating the provisions of new accounting standards. Despite these efforts, significant uncertainties remain, including potential impacts from cybersecurity risks and regulatory changes. Overall, management's approach appears to be centered around risk management, adaptability, and transparency in navigating an increasingly complex business environment. The company has made several strategic moves through acquisitions and divestitures. In terms of acquisitions, the company has purchased YY Live, although an initial attempt was terminated in January 2024. Additionally, IQIYI Inc. was acquired in November 2012, and the online video business of PP Stream Inc. was also acquired in May 2013. the company has also made significant divestitures. In August 2018, it sold a majority equity stake in its financial services business. Furthermore, Du Xiaoman was divested in the same month. The company has also repurchased redeemable non-controlling interests, specifically 16,848,082 preferred shares in 2024. These acquisitions and divestitures demonstrate the company's efforts to strategically manage its assets and focus on core businesses. The company has a history of rewarding its shareholders through various means. One way it has done this is by paying dividends. The records show that the company has paid dividends on multiple occasions, with references to these payments found in several pages of the extracted summaries. In addition to paying dividends, the company has also taken steps to return value to its shareholders through share buybacks. This strategy allows the company to purchase back its own shares from the market, thereby reducing the number of outstanding shares and potentially increasing earnings per share for remaining investors. Concerns about inventory buildup and supply chain disruption are valid concerns for the company. On one hand, there is a potential for shortages or other supply chain disruptions that could negatively affect operations, as mentioned on page 35. This highlights the risk of misjudging customer demand, leading to inventory buildup. Furthermore, the reliance on third-party agents for sales and payment collection, page 51, adds another layer of uncertainty to the supply chain. Any disruption in these external factors can have a ripple effect on the company's business operations. Additionally, shortages in foreign currency, page 73, may restrict the ability to remit sufficient funds for payments or dividends. The decrease in payables for purchasing inventory from 2024 to 2025, page 276, suggests that there is an effort to reduce inventory levels, which could mitigate some of these concerns. However, the potential risks associated with supply chain disruptions and inventory buildup remain a pressing concern for the company's operations and results. That concludes the financial summary for Baidu Inc. Feel free to comment below, and I will be happy to answer them when possible.